and a very warm welcome back to our Insider Interview series. I'm Dave Baxter here at II, and today our guest is Duhra, the Portfolio Manager on the Henderson Far East Income Investment Trust. So Sat, many thanks for joining today.
Thank you.
So many people are familiar with the fund, but for those who don't know it, what makes it stand out? What makes it distinctive?
Yeah, so Henderson Far East Income is an income fund investing in the Asia Pacific region. And the objective is quite straightforward. It's to grow the dividend per share every year, and alongside that, seek capital returns from our region. The thing that sets it apart is not only the high yield. So obviously we have a very high yield. We've sustained that for a number of years. But it's actually alongside that, seeking some of the best structural growth themes in the region. And so when we think about things such as technology supply chains, infrastructure, financial inclusion, we want to be exposed to those great structural growth themes because Asia, after all, is the fastest growing region globally. So doing that alongside each other is really the redeeming feature of this.
And you mentioned that high yield. I think last I checked, it was somewhere around the 9.5% territory. It tends to be the highest yielding equity trust out there. What stocks and which sectors are feeding into that yield?
In some ways, the answer is obvious. There's a number of sectors that you would expect to be high yield. So, utilities, telecommunications, financials, these are all really high yield sectors in our region. And that's something that's not very well understood, is that in our region, we can buy stocks that are 5, 6, 7, 8, 9% yield stocks, in those sectors. And those sectors are actually growing as well. So the financials, for example, through wealth management, opening new branches and so on, are actually growing very fast. And then utilities are doing really well, infrastructure is being built out, that kind of thing. So these are stocks with high yield, but also good growth. Now, alongside that, we have a number of very exciting growth stories, mainly the technology space. And so they don't really have much of a yield at this point, partly because performance has been so strong in recent years. And there we use an option overlay. And so we write options on the more volatile part of the portfolio. So predominantly technology stocks at this point. And that will generate a huge amount of premium at this point. I mean, the level of volatility is just increasing. So the premium being generated is really high at this point. In fact, some of the highest levels we've ever seen. And so it's balancing those two things, using the option strategy to get growth exposure, but having a core of very defensive, high quality names in there as well.
So this is always a big ask, but for those who don't kind of know about them, can you explain in layman's terms what the options overlay is and what you're kind of doing with the other side of that trade?
Yeah, sure. So generally we write calls, and so it's a call overwriting strategy. What that means is that when we have a stock that's performed quite well and we think it's reaching our target price, we can do a couple of things. We can sell the position, we can reduce it, or what we can do is write a call option on that particular position. Now, when that stock reaches a strike price, which normally we set out 3 months ahead, then effectively we will lose the position beyond that level. However, we get on the day one the premium, and that premium can be quite high. It can be maybe 3, 4%. It can be currently maybe 7, 8, 9%. Those are some of the levels we're seeing now. So you get the premium, and that's income for us. However, you can keep the stock, enjoy the upside, but if it goes beyond the strike price, then you give up that position. Now, I think something people would say is, well, then you're going to lose your best performing stocks. Well, we only do it on a small part of that position. So we may maybe do a fifth of that position. And as it moves up, we maybe do a bit more. So we don't expose the whole position to that. So we don't lose a position completely. And so it's actually quite a generally well accepted way of creating income for income funds nowadays. And it's gained more and more popularity as the years have gone on. So I think call overwriting has become quite a nice way of enhancing income for income funds.
And to simplify, I guess it's kind of boosting your income, but it is limiting the potential gains you can make on certain bits of the portfolio. I did want to return to just the point about, I suppose, the kind of high level of yield. I mean, are there a few examples of kind of stocks that are offering those really interesting yields at the minute?
One thing that really stands out when we're talking about these kind of great themes is, for example, Singapore banks. And so Singapore banks have performed really well actually in recent times, but also the last year. They've done a really good job. Now, what they're doing is that they're taking advantage of this kind of huge deposit flow into Singapore, for example. So wealth management is a really strong driver of performance for those names. Alongside that, they're doing buybacks, they're increasing dividends, and they have strong capital positions, and they have pretty steady margins and low credit quality. I mean, pretty much ticks all of the boxes. while that's going on, Singapore is actually attracting a lot of funds. The government is in regulators are trying to encourage more investment into that market. So that money has gone into some of the banks as well. So there's a sector that pays high yield. Some of them pay, 4, 5, 6% yield, but also have a great structural theme behind that, which is all about financial inclusion, wealth management, insurance products, and so on. So that's performing very strongly at this point.
You do have decent exposure to some of those exciting growth stocks that actually have pretty low dividend yields. So think names like MediaTek, SK Hynix, and TSMC. Given that, how do you balance the income and the growth considerations in the fund?
Yeah, actually, that's a very relevant question for what we do, because at the end of 2023, we repositioned the portfolio. So I took over the management of the fund as the lead manager at that point. And we decided that what was happening with our portfolio is that we had too much invested in deep value cyclical names, which optically looked great because they were on very low PEs and had very high yields, but they were essentially value traps. And I think this is where we really changed the way we manage this, is that we then moved into areas such as technology. At that point, we also moved into India. We moved to a number of areas where there was real growth, for years ahead in those particular sectors and markets. That was the key thing, balancing that capital growth alongside the income. So we didn't sacrifice the income of the portfolio. And you can see over the last couple of years, we still have increased the DPS year on year. In fact, we're getting on to 19 years of consecutive DPS increases, dividend per share. But alongside that, you've also seen that the share price has been moving up. We've been tracking the benchmark on the way up. And the reason we've achieved that really is through a lot of these technology names. So if we had not done that, we would not have tracked. We would have really been pretty stable. And so that helped us to move the share price higher because the NAV was moving up. And that's really through these kind of names. Now, the option strategy allows us to do that. It allows us to buy those names and generate income on that. Some of those names you've mentioned, MediaTek, TSMC, we do write options on all of these names. And so we get the upside, but we also get income as well. And so it's balancing those two things. When we're more positive on growth names, we can add a bit more to that, use the option strategy more. And when we want to turn more defensive, we can take that down and add more to the Singapore banks or the utilities and those kind of things, and manage those two parts of the portfolio.
In the last year or so, Asian shares have rallied really aggressively on the back of this big AI excitement. What's your outlook there, and how are you kind of navigating that situation?
So actually, we do have some meaningful exposure to AI theme. And again, as you've mentioned, those names, those technology names, and the Hynix, the MediaTek, TSMC, and so on, are all exposed to that. Now, if you think about when we bought those stocks, it's well before we got this kind of a lot of this kind of hype around the AI story. It was some time back. Now, when we bought these names, we were looking at valuation. We were looking at the potential for income growth. The DPS has been increasing on these names, but also the exposure to things such as autos, the semiconductors that are used in the auto industry, smartphones, PCs, those kind of things. It was not just predicated on AI. And so the AI came along and obviously boosted the performance of these stocks, and is a genuinely strong theme for these companies, because whilst the US companies are investing heavily and you're seeing they are raising debt, they are free cash flow is turning in some cases negative, the beneficiaries of that profitability is all in Asia. So the likes of Hynix and Samsung are going to be some of the most profitable companies in the world. The earnings have really exploded. And so they're actually not very expensive stocks because the earnings have kept pace with the move in the share price, or maybe the other way around. And so that's something that makes these things so very attractive. And so we do like them, but we are managing that risk because there is, for example, a lot of leveraged ETFs in Korea, a lot of retail participation in these names. And so you do have to be a bit careful in some of that. So our exposure is much broader. And so we like financials, we like infrastructure, we like technology, but we have a much broader base of exposure in terms of country and sector than maybe our peers and the index.
Let's drill down now into regions and countries. Where in Asia are you most bullish, and where are you exercising a bit more caution?
So actually an easy way to answer that is to look at North and South Asia, because North Asia traditionally has worked very well for us in terms of valuation, in terms of income generation, growth in dividends. But also it is the beneficiary of technology. I mean, those key technology players are in Korea, they're in Taiwan, they're in China, but also a lot of the dividend growth is coming through in those areas as well. I mean, Hong Kong is doing really well in terms of providing dividends from property, telcos, that kind of thing. So North Asia also has less policy risk and to a degree less currency risk compared to South Asia. Now, the problem in South Asia is that South Asia is very much driven by consumer. And so these are more consumption-led economies. You think about India, think about Philippines, Indonesia, that kind of thing. And also their currency has been very poor. Part of that reason is that inflation has been, maybe not out of control, but certainly has been higher than we expected. And that's because fuel and food is a big part of their CPI basket. So fuel prices have gone up, food prices have gone up, fertilizer prices have gone up, that kind of thing. And there's been also some risk around government policy as well in likes of Indonesia and India. And so those things have seen, a lot of foreign outflow from investors, currency risk, government policy, inflation, weak consumer. So we have less in South Asia for those reasons and a lot more in North Asia. North Asia has outperformed South Asia too. So we still don't see a reason to change that balance.
And what specific countries in North Asia are you, I guess, especially kind of exposed to?
So our biggest weights would be in order Taiwan, Korea, and China. And it's not that we are especially positive on the macro in those places. For example, China, we think there's some real risks around that in terms of macro. However, stock markets don't necessarily reflect the underlying economy in some cases. You think about India, for example, it's a very narrow market. And if you take out Reliance, you take out some of the private sector banks and the IT service names, there's not that much else left there. But that's not really the economy. And same in China. You see these big players like Tencent, Alibaba, and so on. But the real economy is more industrial and it's less represented in the indices. So there can be a mismatch in terms of real economy and the stock market indices. And so that means there's a lot of opportunity in these kind of markets. So in China, we really like the high yield state-owned enterprises, for example. They're performing well. Some of the bank stocks have doubled since 2023, insurance companies and so on. They're doing very well. They're paying very high dividends. In fact, one of our best performers in the last 12, 18 months has been an aluminium company in China, which had 11% yield and doubled over a year. So these are companies that are being ignored by the market. So we look for these kind of things. And then Korea, obviously, we have the memory names that you mentioned. They're doing very well. We have exposure to that. But there's a whole raft of corporate reform. And so that's been very positive for a number of other sectors in Korea as well that have increased dividends. And Taiwan, we think there's really good value technology names with yield as well. So there's a lot of opportunities within that.
And how are you feeling on India? I mean, you've mentioned some of the kind of headwinds there. I guess also another interesting premise on India that I've seen kind of thrown around slightly is the idea that maybe it doesn't have any really obvious kind of AI plays. So it's kind of missed out on some of this like surge that we've already discussed.
That's certainly true because what we've seen in the past, as China's done well, for example, when China does well, money comes out of India to fund China positions. And I think some of that's going on now. Money has come out of India to fund Korea maybe and Taiwan. But having said that, there's been a lot of foreign outflow from Korea as well. I mean, India, saw about $20 billion outflow from foreigners last year. And it's a very high number this year as well. So people don't like that market at this point. Now, it is partly to do with the AI story because that's sucking money out of South Asia and it's going into North Asia. So there's some of that is going on. But India's had its own issues. The macro is not great. I mean, GDP growth has been pretty weak. Nominal GDP has been coming off. And so even though the real GDP numbers look okay, it's a GDP deflator that's creating that number. So I think there's a little bit of a mismatch between what's really going on the ground. If we look at employment prospects, we look at FDI, we look at industrial production. I mean, none of these things look that great. And profitability, I mean, IT services, which is a big constituent of the Indian indices, has been really smashed by the AI story because there's a real threat there. And so those stocks have done very poorly.
Names like Infosys, that
Exactly.
thing.
And
Yeah.
TCS and so on. So I think there's been a bit of a risk around that. And so, we like some of the utility names. Maybe we've been looking at those. Maybe that could be interesting for us. But at this point, we have zero weight in India and certainly been beneficial from a performance point of view over the last 12, 18 months.
I'd be interested to know now how focused the portfolio is on the strong demographics in Asia and the idea of the enriched consumer. I suppose that used to be the real bedrock of Asia and emerging market investing, but it seems like it's been a bit lost in the noise around AI as of late.
So I have to say, consumer, you're right. In years gone by, it has been a very strong story for Asia, particularly in South Asia. in countries such as in India and Philippines, the consumer's been very strong. And those consumer companies historically have performed very well. Even in Korea, for example, when you talk about cosmetics and that kind of thing, the kind of demand from China and so on. However, it's just not working anymore. And one of the reasons is that many of these consumer companies are in South Asia. And what happened after COVID is that the household balance sheet just never got prepared. So people went through a really tough time in South Asia in terms of their household balance sheet. They're financially not as strong as they were. And this is one of the reasons why consumers are still weak in South Asia. They haven't had the support from the government. They are kind of, in some of these markets, such as Thailand and Indonesia and India, they are getting cash handouts, but it's not enough. And so the consumer's still under a lot of pressure. And that means that the consumer stories just don't have that momentum or the growth that they used to. As you say, the AI story has certainly crowded out the consumer names as well. I mean, there's people saying, well, why would we stick around with consumer names when some of these stocks are up 50, 100% in a month? So the money has flowed out of these names, but there is a fundamental weakness in the consumer in many of these markets. And therefore, we don't think the market, that particular sector is very attractive at this point. What we like is some of the names in China, for example. So we have a company called Midea, which people may recognize as from, if you go onto the Curry's website here, you might see washing machines and fridges made by Midea. They also do air conditioning units, and this kind of heat air conditioning units have been flying off the shelf. But it also has a robotics business, which they might list. But that company's doing very well. It's also giving great dividends. And so that, those kind of brands in China that are going international, obviously we've seen that with EV brands, but that's a nice area to be in rather than South Asia consumer.
Well, Sat, thank you for your time.
Thank you.
And thank you for watching. As ever, do let us know what you think in the comments. And if you're a big fan of this series, hit the like button and hit the subscribe button. Thanks and take care.